Good morning and welcome to this Wednesday, October 5th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we made it 2 days in a row to open up October. We got our major indices moving up for a second consecutive day after a very, very rough ending to September. Of course, historically, September is the roughest month of the year. The fourth quarter is the best quarter of the year. So it's almost like spigot gets turned from cold to hot as we go into the fourth quarter. We'll see whether or not that continues, but it does look like we are going to see some weakness at the open. Currently, futures, we've got Dow futures down almost 300 points. S&P 500 futures down about 37, NASDAQ futures 120. Good news is we made, I don't know, maybe 5% or maybe a little bit more on the S&P 500 these last 2 days. So we do have a little bit of room and cushion to those recent lows, but we've got failed, at least based on the futures this morning, we've got some failed tests of 20-day EMAs, at least in the near term. So we'll have to try to work through that. But we'll look at some of those charts in just a minute. For those of you who are new, I want to take you over to Earnings Beats, as I always do in the morning. I want to make sure, very first thing, everybody is aware that if you go over to earningsbeats.com, scroll down, we have a free newsletter. Just like to see everybody get signed up for that. This morning, I did an analysis of a software stock. It's actually in one of our portfolios, so it's a stock I really like. Yesterday climbed back above its 20-day moving average, opened above, closed above. So at least in the short term, beginning to show some strength. Anyway, that was a stock that was featured today. We publish this 3 times a week, Mondays, Wednesdays, Fridays. It may be an individual stock. It could be a key intermarket relationship. It could just be something that I feel about the overall market. Try to make it very educational. And hopefully, you learn from these over time. And I also would hope that it would help in your trading, however you trade, whether you're short-term, long-term, that you'll pick up something from this newsletter to help in your, in your financial success. Anyhow, all it takes is a name, email address, hit that subscribe button. We'll get you set up. We do free events from time to time. I've got a big one that's going to be coming up beginning in November. We haven't announced it yet, but we will. I'll just tell you to mark your calendars, November 5th. It'll be on a Saturday. It'll probably be a couple hours, maybe, I don't know, maybe not quite that long. But again, taking a look at what's been transpiring in 2022 and a little bit of outlook, and just give you some of my thoughts on that. Anyway, make sure you mark your calendars for that. But we'll be reaching out to our Earnings Beats Digest community in addition to our regular earningsbeats.com members for that event. So make sure that you signed up if you haven't already. Go to earningsbeats.com, scroll down, and make sure you get signed up there. The other announcement I want to make is this is the last Trading Places Live show that I'll be doing here at Earnings Beats prior to ChartCon 2022. This is the every other year event that Stock Charts was doing. I think we did it I think it started out in 2011, and then we did 2012, and then it was 2014, 2016, 2018, and then the pandemic hit in 2020. So we didn't do it then. What's back now, 2022. This is a great event. This one's a little bit different. We are actually, there's 17 of us technicians that are going to be flying into Redmond, Washington, into the Stock Charts headquarters. They're opening up their brand new television studio. So we're going to be broadcasting ChartCon from their studio, which I've already seen pictures of. It's absolutely amazing. Anyway, I'll be leaving tomorrow to head out to Redmond to join a bunch of other folks, some really good friends, some industry leading names that many of you, I'm sure, are recognized. And if you've been over at Stock Charts, you're going to know most of the folks that are going to be there. Anyhow, you can register for that. It is a paid event. I believe the cost is $299, but yeah, if you're a Stock Charts member, $99. So even if you're not a member at Stock Charts, sign up for their free 30-day trial. Even a free 30-day trial will knock off $200. So it's a great time to sign up. we use their platform. I trade with their platform. I think their platform is awesome. So I don't know. I wouldn't want to leave the platform to trade personally. But anyhow, if you haven't tried it, now would be a great time, especially if you want to come to this event, save $200. But here's the schedule. You can see day one and then day two. It's going to be a lot of fun. Day one, if for those of you who are interested when I'll be speaking, I'm going to be on this market outlook panel. So I'll be speaking at 4:25 Eastern on Friday. And then on Saturday, I will be in this Bulls versus Bears debate. So hope you can join in, go through and look at all these different segments. It's going to be fantastic. So I just want to make sure everyone is aware of that. Haven't really talked about it too much, but I do want to make sure everybody's aware of it. I think it's going to be I know it's going to be a blast and a great time for us. We haven't gotten together with, I haven't gotten together with all the other technicians that you hear from frequently at Stock Charts in over 4 years, or in approximately 4 years. So it's going to be fun for us, and I think it'll be a great event. And how could the market be any more volatile? With some thinking market's trying to bottom, others thinking we're going a lot lower, the Fed kind of in the mix. I mean, the timing of this event and the name of it, ChartCon 2022, Flying High, Navigating Through Market Turbulence. I don't think it could come at a better time. So anyway, make sure you check that out. All right, let's move on. Let's talk about what happened on Tuesday. We saw another big day in our major indices. The Dow Jones Industrial Average up another 800 points. So one day after getting through 29,000, now we go through 30,000. That's the good news. The bad news is it comes on the heels of some pretty significant selling. So even with this huge rally, we finished 5 points below the 20-day EMA. Pretty amazing considering the size of the rally last 2 days. But that just tells you how bad the action's been for the last 45 days prior to that. S&P 500 up more than 3%, up 112 points, 37.90. The 20-day, 37.99. So again, big day, couple of big days, still got work to do just to get through what I think is the very first hurdle. I mean, we've gone up a lot, but we haven't really done anything just yet, at least not on those two indices. NASDAQ the same, 361 points higher yesterday, 3.34%. Great day. But we're still almost 80 points below the 20-day EMA. Finished at 11,176, and that 20 days 11,253. So still got a little overhead resistance there. Mid caps able to break above the 20-day along with small caps. These two groups are quietly showing a little bit of strength, especially in the small cap growth arena. I don't know if you've been noticing, but small cap growth versus value been doing pretty well for the last couple of months, few months since the June bottom. Things have started to pick back up again in that area. Don't know if that's a bullish sign or not, but still worth mentioning. Anytime growth is leading value in any asset class, I find it's generally a bullish sign. Anyway, mid caps, you can see breaking up and above that 20-day moving average, finished up 88 points yesterday, almost 4%. Small caps also up almost 4%, up 41 points, and they too finished up above the 20-day. So those two indices did clear their first obstacles. We'll see whether or not we hold it, because again, futures down this morning. So we'll have to see how the market reacts to these two up days and whether or not we turn and go straight down, or whether we're able to gather ourselves this morning and make headway and turn positive later today. I think if we do, and we can make our way back above the 20-day on the Dow, S&P and NASDAQ, I think that would be a really good sign. Energy, another big day for energy. Crude oil prices, didn't tell you when I went through the futures, but crude oil prices today up just fractionally, but up near $87 a barrel. We were down around 75 just a little over a week ago. So big move there. We're talking about 16, 17% move in crude oil prices. And that is translated into a really nice move in the XLE, getting back up above the moving averages. You know, when I look at this chart, I just see indecision. I just see it being trendless. We move down below the moving averages, back up above, back down below, back up above, down below, back up above. That's trendless. Trending is like what we've been seeing on the major indices. When we go up and we hit the moving averages, we fail. And so you're moving below the moving average, that 20-day, which is then below the 50. This looks like it's trending right now, at least until we get a breakout above the 20-day. Energy just looks like it's going sideways. Financials. I've been, excuse me. I've been talking about the financials recently because, let me get some water. Hold on one second. Okay, sorry about that. I've been talking about the financials recently because this is a group that tends to like October and November historically. Most of the gains over the last 20 years, the majority of the gains for the XLF have been in the fourth quarter of the gains for the entire year. I didn't do the math, but I want to say probably 70 or 80% of the historical gains in the XLF over the last 20 years have come in the fourth quarter. Now, some of that was because the XLF was hit. Well, actually, I guess maybe, it kind of carried over into the fourth quarter. I was thinking, we started getting hit with the financials back in September of 2008. Remember the whole Lehman Brothers, Bear Stearns, but that carried over into October and November. So that makes this even more impressive that it includes the financial crisis in the fourth quarter of 2008. And still, it represents most of the gains in the fourth quarter. So just keep an eye on financials because we did come back up, climb up through the 20-day. Financials gaining 3.7%. Materials also near 3.7%, also moving up above its 20-day. Discretionary, not able to get through its 20-day, but 3.5% back to the upside. And then finally, industrials up nearly 3.5% as well. And they did manage to climb up above the 20-day. So we're starting to see a little bit of strength and a little bit of bullishness technically, because anytime you're in a downtrend, the first thing you have to do is get through the 20-day. So we almost saw it on the Dow and the S&P and the NASDAQ, but we have seen it on a few of the sectors. The keys are going to be discretionary and technology. They did not get through the 20, and that's why we're seeing our major indices unable to get through the 20 as well. But that would be what I would be looking for. If we do rally off these red futures this morning, later today, if we rally back, what are discretionary stocks doing? What are technology stocks doing? If we can get those back up above the 20-day, I think the technical configuration will begin to start to look much more bullish, but we're not there yet. All right, 10-year Treasury yield. Moving on to the bond market. We only had one economic report out so far this morning. We do have a couple of others later this morning, smaller ones. But the September ADP employment report was out this morning, and it came in almost as the market expected. The expectation was 200,000, and it came in at 208,000. So a little bit of a beat there. August was revised higher, though, from 132,000 to 185,000. So the numbers were a little bit stronger than expected. And the 10-year Treasury yield, you can see, let me give you an update here. Yeah, we're now up 10 basis points. So when I looked at the 10-year Treasury yield at the daily, I was looking, okay, PPO pretty strong. We're going to probably move down, hit that 20-day. Maybe we test 350, and then we bounce back to the upside. Well, we didn't quite get to 350, but we are bouncing. However, on the weekly chart, and I think this is pretty important, the weekly chart, we had a reversing candle off of a lengthy uptrend, and this comes with a negative divergence in play. Higher yields, lower PPO, weekly PPO. So the bigger picture tells me that 10-year Treasury yield could be in for a bigger fall. But within the daily, we're bouncing off the 20-day. So when I see, two different stories, number one, the weekly chart, I'm going to probably carry just a little bit more weight as far as the configuration, the way it's set up. But the daily chart is bouncing off of a key moving average. So if it does fail to get back up to 4%, and then breaks back down below the 20-day, just remember the look of the weekly chart. So the daily chart, if you're bearish equities and you're using this bounce on the 10-year Treasury yield, as a signal that, hey, the stock market's ready to go back down again. That's fine. I even said yesterday in the daily market report to members that, hey, if you're on the bearish side, that move up to the 20-day was an opportunity to go short. That's not the camp I'm in. I will short if I think we're in a bear market, which I thought we were in from the very beginning of 2022 through that June low. Once we set that June low and it's all the rotation to more aggressive areas, I saw that sentiment getting reset. That's when it started to look to me like, hey, this is probably the bottom. And once I turn back to the bullish side, I will not short. That's just the way I trade. So I have no interest in shorting the 20-day test. But for those of you who maybe are more of a, more of the bearish mindset, or you just like to short-term trade on both sides, I mean, that's fine. The 20-day EMA is one of those areas that I would be looking for, because if the market breaks back out above the 20, you can get out quickly. For me, trading is all about managing risk. It's not about being right every time. So if I believe the market's bottoming, the last thing I want to do is be short, because if I'm right about my bottoming call and the market goes up, what am I doing on the short side? That's the worst possible trading scenario for me, is to make the right call in the market and then simply just be on the other side. So that's my philosophy. So I'll either be cash or I'll be in. And right now I'm in. Unfortunately, I was in the leveraged ETF on Friday morning. Let me show you. Let's move on to the 10-year or to the S&P 500. Pull up the 5-year chart. This is how, I don't know, tenuous things can be when you're in a very fearful market. I've said before, when I call bottoms, sometimes you can be off a day or two and it can be painful. So right here, early on Friday, I sent out the daily market report, a special report out to members, and said, listen, the sentiment has gotten to a point that's crazy. I believe the market is poised for a rally. I think we were seeing at that point a lot of money rotating into growth areas of the market versus value, even though we had gone down and set a new low back on Thursday. And so it just looked like things were ready to go. So right about in here, I got into leveraged ETFs, sent out the daily market report to our members, and literally an hour later, it looked genius. Looked like the move was genius. And then the afternoon came, and we ended up going back down, closing back at a new low. And I don't hold leveraged ETFs when the market is closing on its low and breaking down. So I ended up selling in the afternoon on Friday. And you can see that was not good timing. The call was good, but again, if you're off a day in a market that's extremely volatile, VIX in the 30s, equity only put call ratio up in the 0.80s, I kept saying, when you get sentiment to this level, it's like pulling a rubber band back. And the more it goes down and the more fearful things get, the more you can pull that rubber band. And when the bulls finally get control, you let go of the rubber band, and it is a snapback kind of rally. Look at what happened the last 2 days. 5% move in the S&P 500 in 2 days. That's what I'm talking about with a snapback rally. Unfortunately, I didn't have my leveraged ETFs. I was in the QQQ, but I was not in the leveraged, which I had gotten out of because of the close on Friday. So that can just show you how frustrating it can be. But I try not to worry about that. I let my signals do the talking. If I have to take a loss, I take a loss. I move on. The more you look back, I mean, I've made some really good trades, and you never really look back on those. You just think, oh, I'm brilliant. And then when you make a bad move, that's when you look back and say, well, I should have done this or I should have done that. And that clouds your vision for the future, for the next trade. So I think you really want to be careful about that. But anyhow, this is the rally that we've had, 5% or more on the S&P 500 the last couple of days. Big move. And look at those solid hollow candles. That helps on the AD line. So you can see the AD line starting to turn back up again. Here we are trending lower and lower all year. And look at the AD line. I mean, back in mid-September, before we had that big drop, the AD line was at a 52-week high. It was at a 2022 high. Actually, I think it was an all-time high. So there's still buying going on, even though the market's been going down. So eventually I see us breaking back up above the 20 and strengthening and getting things going. We are in the fourth quarter. For those of you maybe who are new to the show and maybe haven't heard, I talk a lot about history from the October 27th close. So that's coming up in 3 weeks. October 27th close to the January 18th close. The S&P 500, if you just looked at where it is at the 27th on the close of October and the 18th of January, we've been higher on January versus that October close 62 of the last 71 years. Fourth quarter is by far the best stretch historically for the stock market. Now, we've had down years. Think back in 2008. I mean, we were in a free fall back then. So it's not a guarantee. And some of you believe we're in a secular bear market. We're going to keep going lower. It wouldn't be unprecedented for the market to keep going lower and have a really bad fourth quarter. I'm just telling you the odds don't favor it based on history. We'll see. All right. Let's see. NDX. Not quite the same kind of move, if I'm being honest. Just looks like more gap up and less actual move during the day on many of the big NASDAQ stocks. I looked at some of the software stocks yesterday and they made moves, but a lot of it was at the open and then they were up early and then they started selling off in the afternoon. So they're still not, if you're looking at this market and you're trying to, decide, are you really, really overwhelmingly bullish? It's hard to get into that camp when you've got semiconductors and software and internet stocks still acting the way they're acting. Even with Elon Musk yesterday announcing that the deal with Twitter is back on again at the original price. I mean, I was like, oh, wow, this is really going to help the internet stocks. And yeah, I mean, we went up, but we were up most of that at the opening bell. And intraday, I mean, you can kind of see, did we really do much after the opening bell? Back on Monday, look at the way we finished coming down. So it's still not quite. Does it look like the S&P 500 to you? I mean, again, let's look at the S&P. Lots more buying, straight up move in the morning and then closing on the high. And then I come back to the internet, just doesn't quite look as good. And even if you pull this up, I mean, this is internet relative to the S&P 500. We got a really good, I mean, that's a big announcement in the internet space. And it's almost like the market yawned. So I think we're going to know we're out of this when those three groups, semiconductors, software, and internet, finally begin to show some leadership. And if I pull up the software group relative to the S&P 500, I mean, there was your nice move in the morning. Remember, I was just saying how many of these software stocks went up in the morning and then just kind of fizzled out during the rest of the day. I mean, I'm not trying to make this bearish because it's still bullish, but I would just like to see software stocks lead throughout the day. We had a pretty good day on Monday after an early drop, but then Tuesday it seemed to fizzle out after about 10 or 10:30 in the morning. Semiconductors, some of them have started to, make a pretty decent move. Here's the, rally that you can see over the last couple of days, few days. So they're looking better, but let me pull this up for you on a daily chart. Here is semiconductors relative to the S&P. What do you see here? Not much. I mean, here's your last couple of days. Yeah, look good on a 5-day chart. Not looking very good here. And I'm not trying to paint a bearish picture. I'm bullish. But I'm also a realist. And the stock market is not going to have a sustainable move to the upside, in my opinion, without semiconductor, software, and internet. That's when we're going to know it's for real. Those groups need to really take off. We topped on the S&P 500 back in mid-August. Look at what semiconductors did. Nice rally, And the week and a half before the 15th, we rolled back over again. That's not what we want to see. We want to see this group really moving higher. So let's break this down channel. Still got some work to do. All right. Let's take a look at some earnings, just a couple that were out. SGH, this is a small company. I think it's less than $1 billion, but it is a semiconductor. It's one of the first semiconductors to report earnings. So I just wanted to kind of go over this one and just show you that the stock itself had been downtrending. Relative strength, as bad as semiconductors have been here, and as bad as their relative strength has been, SGH has actually been a relative underperformer in the group. And they reported, I did not see their numbers, but I did see this 3% drop pre-market. So 1646 looks like, after testing the 20-day, unless semiconductors catch fire today, I would expect that this is a stock that's not been performing well. We're probably heading back to test that 15 and a quarter area. Now, 3 stocks that reported this morning. First is RPM International, stock up 3%. I mean, you can see it broke back up above its 20-day yesterday. Going to tack on some more up in here. I think it's probably sideways consolidating. So maybe it makes a run for 96, 98, but got to keep the recent lows in play as well, because I'm not sure that this is trending just yet. We'd have to make a breakout before I'd feel a little bit more bullish there. LW, Lamb Weston, another one pretty good report, or at least pretty good reaction. This one looks like a cup. Nice uptrend. Certainly looks like a cup here. Where looks like 80-40 is where we're trading pre-market as we get ready to open. So maybe this is going to start that right side of the cup back to about $82, $83. That's what it looks like to me. So this one has a pretty nice bullish feel to it. And then there's this one that does not have a bullish feel to it at all. And that was Helen of Troy, HELE, reported. Look at the move, down 17% this morning. I want to pull this chart up, and let's look at it on a relative basis. I mean, the stock made a move the last couple of days, but look at this, from 210 down to 100 just in the last 4 or 5 months. It's in a bad group. You can see its group relative to the S&P is horrible, one of the worst groups. And look at Helen of Troy relative to the group. It's been falling apart for 5 months. Now, again, I didn't see the results, but I'm not surprised by the reaction. I would not have expected a good report. I use relative strength a lot when I'm looking at earnings reports, because Wall Street's been out to talk to companies. They talk to companies' management teams. They find out before the quiet period begins what these companies are doing, what their competition looks like, their forecast, and then they decide what they're going to do with their money. We don't know, except when I look at relative strength. Why would Helen of Troy be looking like this on a relative strength chart? Well, Wall Street doesn't like Helen of Troy. That's my conclusion. Pretty simple conclusion to that story. Anyhow, I would always be careful with a stock that's showing relative weakness like that in a weak group. I mean, it's hard to expect good things coming out of that. All right. Anyway, earnings. I think Constellation Brands reports tomorrow. So that's one maybe to keep an eye on tomorrow morning. But that's it. So let's move on to the 3 you must see, and we'll wrap this up. I want to go over 3 gambling stocks. The gambling stocks have just been, they're almost like the cruise lines, up and down, yo-yos, trying to figure out which way they want to go. Las Vegas Sands, I pointed out recently, $40, needed to get a close over $40. And you can see all of these tests. Look at the gap ups recently above 40, and we couldn't hold. And then we're right back down again. Well, yesterday, hard to mistake that candle. Volume picked up to over 10 million shares, and we finally closed over 40, closing all the way up at 42. So now $40 becomes your support instead of resistance. So LVS looks kind of interesting. Wynn Resorts, another one. Big move yesterday. still trying to get up through $70. Big day, and maybe we did close just slightly above. I don't think this breakout's nearly as convincing as the one on LVS, so I like LVS a little bit better. But Wynn Resort's trying to get back through. Watch the rising 20-day. If we do pull back, I would expect that to hold. And then the last one here, which is Caesars Entertainment, CZR. Do you notice the difference in charts? If you're looking at gambling stocks, not all stocks are created equal within a industry group. Las Vegas Sands breaking out over the past several months highs. Wynn Resorts attempting to do the same thing. And look at Caesars. Its highs are up here in the 50s, and we're trading at 35. Something's going on here. It tells me that if I was going to buy a gambling stock, this one would not be the one. Anyhow, let's get a quick update. I do want to mention to everybody, especially earningsbeats.com members, because of my travels out to Seattle this weekend, I'm leaving tomorrow. I'll be traveling all day tomorrow. There's a lot of things planned out at Stock Charts. I don't come back until Tuesday. There's going to be quite a disruption to our service this weekend and throughout the day. I did talk to John Hopkins. He'll probably be, just posting something about the overall market and how it's looking each day while I'm gone, but there will not be a regular daily market report. I don't know what you're going to have for a weekly portfolio report on Sunday or Saturday. If I can get the time, I'll try to do something brief, but it won't be anything, it won't be as much as I normally do for that report. The shows, I'm probably going to record a show for tomorrow. I'm not sure yet if that's the case. It might be an evergreen, one of these shows that I do when I'm not available that kind of stands the test of time. So it might be something like that tomorrow. Friday, I don't do shows anyway, so that's not a problem. Friday, I'll be at ChartCon. So remember, Friday and Saturday are ChartCon 2022. Monday, I will not be doing this show, Trading Places Live. So you won't have anything on Monday here. And Tuesday, I'll be traveling back. So obviously no Trading Places over at Stock Charts. Wednesday, I should be back to a normal schedule. So I want to just make sure everybody's aware. All right, looking at the market here as we open, Dow Jones down 265, S&P down 36, NASDAQ down 124, VIX back up a little bit, not bad. It is back down below 30, which is good news. The strength in the market the last couple of days definitely sent the VIX back down, but 29 still really high. We still have to be on the lookout for just about anything. So watch that 20-day. If we can't get through, there's only one other option. That's to go back down to where the recent lows were. So can't get through 20-day. I would be expecting a little more of the same in the near term. Just remember, fourth quarter, historical strength. Later in the fourth quarter is where it really begins to kick in, heading into November. Last few days of October into the beginning of November. So anyway, with all that, I think that's it. So everybody have a great day. I will be back here at Earnings Beats for your next Trading Places Live next Wednesday. So mark your calendar for that. Anyway, have a great day, everybody. Happy trading.